Now, let's move to some practical considerations. The first practical consideration that we need to consider is related to the fair value determination. We have one accounting standard related to the fair value, which is IFRS number 13. Determining fair value may involve using market prices, valuation models, or expert appraisals. It requires careful judgment and consideration of all relevant information in order to assess the fair value. The second practical consideration that we need to consider is the impact on the financial statements. The opening IFRS step financial position may result in changes to the reported value of assets, liabilities, and equity compared to the entity's previous financial statements prepared under the different accounting framework or local gaps for the previous period. So, example, Company L opening IFRS balance sheets may show differences in the value of assets and liabilities compared to those previous financial statements due to the application of the fair value measurement. Now, due to the importance of the fair value measurement in IFRS number 1, we need to focus and give more attention to fair value measurement. And all of what I'm going to explain now is aligned with the IFRS number 13. So if you study before IFRS number 13, so you will find that all of what we are going to discuss in this chapter is also related to IFRS number 13. It's being aligned with what we discussed before in IFRS 13 chapter. So let's start firstly with the definition of the fair value. As stated before in IFRS 13, and this is the same definition of the fair value under IFRS number 1, fair value is the price that would be received to sell an asset. So if your company is going to sell an asset, the price that will be received is the fair value. Or paid to transfer a liability. So if you have a liability and you are going to settle the liability, the price that you are going to pay to settle the liability is called the fair value. But we have some conditions for this price to be considered as fair value. What are these conditions? Number one, it must be in an orderly transaction between market participants that are knowledgeable and willing to finish the buy and the sell transaction and being measured at the measurement date. So as you see, it represents a market-based measurement emphasizing the exit price from the perspective of the market participants, not the entity. So it doesn't depend on internal factors or internal pricing, it depends on exit prices. So the attributes of the fair value, that it is firstly market-based, derived from observable market transactions or based on market assumption. And secondly, it reflected the price at which the asset or liability could be sold or transferred, meaning that it is exit price. So as an example, company M, which holds an investment in securities, the fair value of this securities is determined based on the price that would be commanded in the market if sold today. And based on IFRS number 13, there is a hierarchy of fair value inputs. Fair value measurements follow a series of 3 levels or a hierarchy of 3 levels that categorizes input into 3 levels. Level number 1 is all about quoted prices in active markets for identical assets or liabilities. And if you don't have information regarding quoted prices in the active market for the same asset, so go to level number 2 and search for observable input other than quoted prices, such as market prices of similar assets or liabilities. And if you don't have information or inputs related to level number 2, so you have to go to level number 3, which is the last level in this hierarchy, and depend on unobservable inputs, which are often based on assumptions and estimation models, such as valuation techniques. So what are the valuation techniques that are related to the last level, which is level number 3? The valuation techniques are market approach, which means that we are using prices or other relevant information for market transactions, such as, for example, if you would like to do valuation for a share or for stock that you are investing in, you are depending on the comparable transactions or the value of other comparable transactions in order to estimate the value for this share that you are investing in. So in this case, you are considering market approach. And the second approach is income approach, which means that you are estimating the future cash net flow and you are discounting this future cash flow in order to calculate the present value. That's why it's called income approach, because you are estimating the future cash flow from using the asset. And last approach, that it's called cost approach. And in this cost approach, you are evaluating the cost to replace the asset or the cost to reproduce the liability. So as an example, if company M owns a piece of machinery, the fair value may be determined using the cost approach, considering the cost to replace the machinery with similar assets in the current market. So the question here is when to use the deemed cost. While IFRS number 1 generally prescribe the initial recognition at fair value as of the transition date, it acknowledges also that fair value is not always readily available or reliable for some assets. And in these cases where the fair value is not readily available or reliable for some assets, IFRS number 1 allows using the asset's historical cost as being deemed cost as a starting point for recognition. And here is a breakdown of these scenarios. If the fair value can be determined in a reliable way using recognized valuation techniques and assumptions, it should be used for initial recognition under IFRS number 1. This provides the most relevant information about the asset's current value at the transition date. And if the fair value cannot be measured in a reliable way, IFRS number 1 allow using the historical cost of the asset under the previous gap as being a deemed cost for the initial recognition. This serves as the practical and consistent alternative until the fair value becomes reliable available. However, it is important to note the following. Deemed cost is not a substitute for the fair value and should only be used when the fair value cannot be reliably measured, and the deemed cost might need some adjustments to conform with IFRS accounting principles. For example, if the previous gap depreciation method differs from those listed under IFRS, so in this case, the deemed cost might need to be adjusted to reflect the appropriate IFRS depreciation, and then this carrying value will be considered the deemed cost under IFRS number 1 at the transition date. Therefore, the initial recognition process under IFRS number 1 involve two-step approach. Number 1, assess the fair value measurability and determine whether the fair value can be reliably measured for assets or not. The fair value or deemed cost is the next step and that you have to select from. If the fair value is reliable, then use the fair value for recognition. And if not reliable, so at this case, you have to use the deemed cost based on the previous gap historical cost. By following this approach, you will ensure a faithful representation of the asset's value in the initial financial statements under IFRS number 1, adhering to these principles while acknowledging practical consideration. Now, again, in this regard, there are some practical considerations that we have to note. Number 1, the consistency and comparability. Entities should consistently apply fair value measurement principles and use similar techniques across similar assets or liabilities, because this ensures comparability of the fair value information. And number 2 of these practical considerations is the documentation and disclosure. Complete and transparent documentation of the fair value measurement process is essential. Entities are required to disclose the fair value measurement methods that they used and the level of the fair value hierarchy for each measurement, whether it is level 1 or 2 or 3. So, for example, company M, when reporting the fair value of its investments, should clearly disclose the valuation techniques that they use and the level of the fair value hierarchy to enhance the transparency for the stakeholders.